Hello and welcome to Aditya Birla Sun Life Mutual Fund presents Voyage 2020 Navigating to a Better Tomorrow, partnered by ET Now. The final day of the digital edition of Voyage 2020 began with a conversation with the Chief Economic Advisor to the Government of India, Krishnamurthy Subramanian.
I'm sure because of this crisis, the shape of the economy will change and it is bound to change. Whenever things will normalize, how do you think the shape of the economy, at least in India, will change?
Whenever participants take into account what I'm talking, they should not just focus on what I'm saying as my prediction, but keep in mind the uncertainty that I've actually talked about. That nuance is very important. With that preamble, now let me say what are, I think, the important changes that will happen in the economy. I think for one, the sectoral allocation between services, manufacturing, agriculture, that may actually also have an impact. And from India's perspective, this possibly is a good opportunity to do a reset and enhance the scope of manufacturing in the economy, because unlike services where the social distancing sort of puts some question marks on some very key service sectors, because compared to manufacturing, services is a sector which relies a lot more interpersonal interactions. Therefore, this COVID episode, for the time that it lasts, it's likely to have a greater impact on service sector than on manufacturing. And because we are a population that has a large number of youth who need jobs, manufacturing is that outlet that can generate jobs. Together with companies that are actually in China, many of whom who want to relocate. So this these are some of the sort of favorable conditions that are coming together for India to reset and actually increase its its presence in manufacturing in terms of globally, but also within the country itself to have far more manufacturing presence and thereby create jobs. So that's, I think, number one key change that I foresee. Second, as you would have seen, today you must have read about the Department of Personnel in the government, thinking about 15 days of work from home, for government employees. I think it's a very big mindset change. Oftentimes status quo is one thing that tends to be, lot more likely to be perpetuated in any government, be it in India or anywhere else, actually. And so this is an important change, and it signals the fact that the way we work is also quite likely to change, not only within the government, but also in the private sector as well. A third key thing, I think, is, if you look at, and of course, what I'm going to speak about has come with its costs, but the pandemic and thereby the lockdown is by far the best natural experiment on how too much economic activity can basically have a detrimental effect on the climate, for instance. From India's perspective, while there will be short-term troubles, and the government is trying its very best to alleviate these troubles, I also look at this as an opportunity, and hopefully we will basically go and we'll be seizing.
I mean, in India, the borrowing rate still remains quite high. Even now, when the median market estimates are of 0% growth, 10 years sovereign is trading at 6%. Over the last 5 years, I mean, inflation has averaged around 4%. Weighted average lending rate has been around 10%. Would you agree that we need a more radical reduction in rates, maybe closer to 0% or something like that? I mean, given the fact that growth is supposed to be quite low, and as you rightly mentioned, that policy space in that direction is much higher.
In a market economy, rates are determined by demand and supply. I think and intervention makes sense when there is a market failure. Government intervention makes sense when there's a market failure. So that's a broader point. We can talk about possible, is there a market failure in the market for Government of India bonds, etc. I don't know. I don't think there is. There is a possibility for for basically the space on the monetary side to be utilized, because this year certainly output will be significantly lower than the potential output, and if you look at in India historically, the term spread is basically the difference between the 10-year rate and the long run rate and the short run or the repo rate, for instance. Historically, the spread has been 1%, about 1% or thereabouts. So if we are able to, reduce at the short end, then it's possible the long end might come down. But I must, by the way, say that, what has happened with the yield curve now is, in some sense, it has actually, the long end has remained where it has, and the short end, it just has pivoted, with that. Basically, because of the rate cuts, the short end has come down, but the long end has actually not come down. Typically, what happens is, when there is a parallel shift in the yield curve, when the short end comes down, the long end also comes down. But the long end has continued to be where it is, and actually it has just pivoted. So the term spread has increased. Now, you must remember that even if, let's say, monetary policy, goes and brings down this particular, the shorter rate, if this end continues to be where it is, then, borrowing costs will be higher. So there is a possibility, therefore, for some quantitative easing, and, the RTO operations that RBI is doing actually is intended in that direction, but it can be, some of the operations can be targeted at the specific, the long run rate itself, and that may help. But overall, I think I would say that in a market economy, these have to be determined by the market, and I don't think regulatorily mandating some rate will have far more costs than benefit.
The challenge for the economy right now is confidence of a crisis in terms of lending. RBI has done a fantastic job of bringing liquidity back. Banks have surplus liquidity. Banks are saying we want to lend, but we have to be cognizant of risk in NPAs. Now, government cannot force banks to lend. That's not the right thing. Government is doing the bit by letting MSCs borrow. But is that enough? Because when I speak to bankers, they are not scared, but they are worried. When I speak to RBI is astonished that why banks are not lending. The system has got jammed. It's fear or something else, I don't know. So what can be done?
If you pay, careful attention to the, to the 20% extension of working capital and term loans, 3 lakh crores of it through the MSMEs. What we did is we basically have given 100% guarantee on it, which means basically the bank does not face any risk at all. The bank is, effectively the bank can price it like a risk-free loan, because the entire loss on it is borne by the guaranteeing corporation, which itself has been provided, the capital by the government. So in this case, the risk aversion, which is what is holding bankers back, which is why they're sitting on 8.5 lakh crores of, of basically reverse repo money with the RBI. Now, 3 lakh crores of that can actually be put into the MSMEs, and 3 lakh out of 8.5 lakh crores is almost like 45%. So, and by making it completely, risk-free, and this is something I can actually share with you. We had, deliberations on it initially saying, what if we basically have, let's say, first loss guarantee for 25%, 30%, etc. And when we were thinking about this, and then we felt that, if we don't give 100% guarantee, then even with a small residual risk, it's possible that banks basically may feel skittish in lending. And so it is really critical for us to actually, have that 100% guarantee.
This was followed by the CIO Fixed Income Investments at Aditya Birla Sun Life AMC, Manish Dangi, discussing portfolio strategies for a post-COVID-19 era with the co-founder of Wealth Forum, Vijay Venkatram.
Everything that's happened in the last 18 months, can we take a step back and try and distinguish what out of whatever happened were mistakes that we as an industry have made, and what out of those are market risks that distributors and investors have to accept as a way of life when investing in the fixed income?
I would think that, majority of what played out, was a market risk. And let me sort of give you a context of it. There are various ways to look at the losses which happen in fixed income funds. One way is what I was trying to explain, that the cumulative write-offs that industry would do in 2018 and 19 and 20 would be about 12, 13, 14,000 crore, somewhere there.
Right.
12 lakh crore industry, that's just about 1%. Okay. Now, is it big? Is it very high? Of course, when I lose $1, it appears very, very big. But now,
when you translate it to 1% NPA, it doesn't look that bad.
Yeah, but you ought to contextualize in terms of what has been happening to credit markets as such. Look at any asset class. Even the most benign asset class that you could think of is government bond. How can there be risk in government bond? But you, as a distributor and advisor, know this. Then in last 15 years, there have been 5 years that government bonds actually give you negative returns. In 2010 beginning, had you invested in a government bond, you would have earned about 13% negative return and concluded that what the hell is this? How could I earn such little return from a government bond? How could risk materialize in a government bond? But again, that's a part of cycle. Concluding not investing in government bond then and investing in fixed deposit, and I know, would have been a wrong call. Because government bond fund over next 10 years after December 2010 delivered close to 9.5% versus fixed deposit would have earned you less than 7%. Okay, so that's another context of looking at market risk.
What are some of the things that in hindsight we ought not to have done in the last 18 months?
One is as an asset manager, now we know in hindsight that the fixed income AUM can dwindle, and the investor is prone to groupthink. Okay. Frankly, I've been an absolute admirer of Franklin's liability franchise, but there is a bit of a shock in the manner that there is a run which sort of played out, even on a franchise which actually had a reasonable liability franchise, So knowing this very well, I have to admit that, our view that, we could take 3-4% in a group or a company was the wrong call. We thought 3 or 4% is fine. But that 3-4% actually, when risk materializes, in the run up to that point, it becomes 10% because people run. So I think that's a big learning. The second we realized, of course, is that, in India, for whatever reasons, I think our law is relatively weak. The contracts are not yet executed well. We realized that the group's influence on a good company of a group, could be very high. Apart from that, I think the bad learnings could be that as fund managers, we may conclude that what is in it for us to run risk? Okay, look at the one who ran so much risk actually had to shut down. And therefore, we may conclude that it's not worth running that risk. Now, there will be a wrong conclusion. As long as right now we all are risk covers for the right reasons, that risk can materialize, it's fine. But let's not conclude it as a durable strategy. That's one.
Yeah.
Number two strategy, my fear is that, that it is possible that many of you, many fund managers, many managements may conclude that structured finance is bad and vanilla finance is good. It's bad decision. Structured finance, for all the wrong that it may have appeared to you, yet could ensure that, you actually minimize the loss given defaults.
Welcome back to Aditya Birla Sun Life Mutual Fund presents Voyage 2020, Navigating to a Better Tomorrow, partnered by ET Now. Continuing with our focus on the fixed income sector, the head, product and segment Private Wealth at ICICI Securities, Bharat Parikh, was in conversation with two senior fixed income portfolio managers at Aditya Birla Sun Life AMC, Kaustubh Gupta and Sunaina Dakuna.
So Sunaina, what are your learnings over last 18 months, right? So when Templeton delivered a negative return or the scheme went for a shutdown, there will be some learning for you, and there might be some changes which you guys might have thought of, right, as a part of the process, how to really want to change it.
One of the primary learnings that all fund managers would have had, and including us at Birla, is that of concentration. You have to be very careful at the time of building up the portfolio. I think the fundamental learning that a lot of people would have is, of course, you always diversify your portfolio, but maybe proactively, instead of taking 3%, which optically and regularly sounds like a decent number, you already pre-plan for a situation like this where you have sharp drawdowns in AUMs, and then automatically at inception only you take 1 to 2% of your AUM in a particular security. So I think first big learning would be, say, concentration. What have we done at Birla? We have built binding constraints for each one of our portfolios. These have security-wise constraints with respect to how much per security you can take, how much per average rating category you can take. So that's something that one of the learnings, key learnings. Second is in terms of liquidity. I think liquidity management, and more importantly, asset liability management, is extremely important, because as in open-ended funds, in effect, we're actually managing what could technically actually be a couple of days worth of money or 1 day worth of money. So you need to ensure that your ALM is actually managed very well and you maintain a lot of liquidity in your portfolios.
Kaustubh, why do you even really invest in credit risk fund, right? What are you really looking for? Why do you really look for that fund?
Whereas the point is that not running risk itself is a big risk. Let me talk in terms of number to make you realize what I'm trying to say. Today, when there is a risk, so much of risk covers, each fund house is coming out and they are putting on their website that how much AAA and SLR papers they are running in their portfolio as a fixed income category. And these numbers are broadly about 95% for the industry, at least for all large fund houses, when they are saying that 95% of their AUM is invested in AAA papers. Now, if you go back and look the old portfolios, in 2018, this number was about 60%, which means that over the last 2 years, fixed income as a category, the fund managers, they have migrated about 25% of their investment from a AA as a category to AAA as a category. Now, on an average, the spread between AAA and a AA paper is about 2% to 3% is general spread. Even if we assume that 20% is the migration. Okay, so on a 12 lakh odd crore industry, 20% is 2.5 lakh odd crores. And on that 2%, if you're losing, which means that per annum, we are losing 5,000 crore of additional interest that we could have gained per annum. If you compounded it, then the number is even higher. So effectively, the total loss that the industry, or I will say the potential loss that the industry has incurred, is about anywhere between 10 to 11,000 crore over the last 2 years. So the point that I'm trying to say is that till the time the fund management team can ensure that both the probability of default and loss given default are less, I think this category deserves its due credit.
For the final session at Voyage 2020, the founder of Isha Foundation, Sadhguru, shared his thoughts on the theme Voyage of Expectations and Acceptance.
Sadhguru, medical experts are calling it the biggest crisis in the last 100 years. Economists are saying this is the biggest recession in last 100 years. Everybody is getting affected. The crisis is big for some, it is small for some, but it is crisis for all. How can one emerge as a winner in this time of crisis?
So it's during challenging times that human beings have to be at their best, because the world demands your best. But a whole lot of people get into this mode of fear, anxiety, tension, depressions, frustrations. We must first appreciate that after 6 weeks, when over 350,000 people have died around the world, you and me are still alive. That's a success. So that's a first success. We are still alive. Now that we are alive, the next thing is family, economy, variety of things that we need to handle, our responsibilities for people around us. Well, conducting all this gracefully is the most important thing. For this, it is most important a human being should be well equipped within himself or herself. Right now, we have taken to this mode. Everywhere it's being propagated or projected like this on the television, in the movies, everywhere it's being projected like this. When there is a challenging situation, you must freak, you must throw things around. You know, this is becoming the way of all the movies and television shows. This is something we need to change. When things are difficult, we must be at our best. For this, as there is technology, science and technology to create external well-being, there is a whole science and technology to create inner well-being. Every one of us should make use of this, especially in this country, where this is the USP of this nation, how to keep your interiority. This is the fundamental nature of our culture. Unfortunately, many have moved away. I hope at least in these difficult times, everybody will come back and understand human experience is determined from within, not from outside.
What do you think this experience will teach us? You always said past lives in our mind, it is time to move forward.
Most human beings are suffering. What happened 10 years ago, they can still suffer. What may happen day after tomorrow, they're already suffering. So memory and imagination, which is a unique capability in a human being compared to any other creature, unfortunately we have turned our own faculties against us. We may call this by many names. We may call this stress, anxiety, depression, frustration, whatever you want to call it. There are 72 exotic names for this. But essentially, we have turned our own intelligence against us. We need to take charge of this, it's very important. Those of you who are in financial markets, I don't think you are new to, unpredictable situations. This is just one more for you. You've gotten into the financial market because you enjoy the thrill of riding unpredictable situations. When you ride it better than somebody else, you are a big success. When you fail to do that, you are not. I'm not trying to belittle the situation. The situation is quite serious, there's no question about it. But this is the situation we are in. As a generation of people, shall we come out successfully or not? Coming out successfully means what? Can we fix everything in the world? Maybe not, but we don't have to make this into a major suffering. We just have to see how to be resilient, how to be strong, how to ride this wave.
The fear is back, and the fear this time is real. How can one overcome?
No, fear is not back. Most people are creating almost every day. Going to work, they are fearful, coming back, they are fearful, everything they are fearful. Fear essentially means that you have no control over one faculty called imagination. You imagine things which are yet to happen. So, when you try to live a tomorrow today, naturally it'll go crazy. One way of living a tomorrow today is you fantasize wonderful things for yourself. But it can easily go wrong. If you start living in your imagination, imagination can easily go wrong. Imagination is good as a way to project like a plan and see how to execute it in real life. But if you start living the imagination, fear is a natural consequence. There is no other way. It may be pleasurable to start with, but after some time it will become fearful, your paranoia will come into you. All it takes is a little prod from the situation. Right now, when so many people around the world are dying, you're alive. Should you be fearful or joyful, tell me?
That brings us to the close of the 7th edition of Aditya Birla Sun Life Mutual Fund presents Voyage 2020 Navigating to a Better Tomorrow, partnered by ET Now. We hope that the multiple sessions with sector experts and thought leaders have helped you become better prepared to navigate to a better tomorrow. Thank you for watching.